Hello, everyone. Welcome to the market update here for Tuesday, February the 14th. Happy Valentine's Day, everyone. If you have any questions during the week or any questions that I don't get to here in the live class, make sure you send those to Jerry, Jerry, at TradersPro.com. If you forget that email address, it's always in the beginning of the recording of the class, so you can, if you view the recording, you can see it there. All right, let's get started. The direction alerts, again, not too much to talk about here. I do want to point out, again, something we've been watching. We're getting close to -5. So if we continue to move, the market continues to move higher, we start to get above 4, you'll see this slide bar start moving in this direction towards that bull market signal. This is a long-term signal, so it doesn't change very often. And when you're right when you're in the big part of the bear market, the big part of the bull market, it can just sit at the extreme range there for quite a while. And but that's something we'll be looking for, is if we start to see that start moving towards that bull market condition. You can see right here is where it slid from the bull market into the bear market. Now, there's a lot of different definitions of bull market, bear market out there, okay? And to be honest with you, it really doesn't matter what the definition is, as long as you're consistent in using it. Whatever you want to use to define a bull market or a bear market, just be consistent with it, because otherwise you can adjust it to tell you whatever you want to tell you. It's like you can use one that gives you a signal earlier when you're bullish on the market, you want it to be a bull market, and you could use one that lags and gives it shows you later if you want to remain a bear or believe the market could go down. So you don't want to be able to pick and choose. And this is how I feel with things like moving averages as well. If you're just be consistent with the moving average that you're using. If you're using a 200-day moving average for your long-term trend signal, and then suddenly you say, oh, but look, it's now bouncing right off the 150-day moving average or the 100-day moving average or something like that. Like I said, you can find evidence out there to support whatever your bias is, and you want to make sure you're not falling into that trap of finding something to confirm your bias. I did a check here with the audios. The audio, I'm sure you guys now will let me know if the audios, if there's a problem with the audio. Looks like someone did. Okay, you got the audio. You weren't hearing anything, and then suddenly you were able to hear. Okay, good. All right. Okay, let's keep going then. All right, so now the other alerts. Momentum is, we kind of pulled back a little bit with the recent market correction. We're back in kind of the mid-range here. This is not telling, all we're looking for here is overbought, oversold. Are we in this extreme range here or extreme range here? The market is not stretched in any significant way, except for sentiment, which it's been that way for a while. So if the market does want to run right here, there's room for it to run, or if it's going to sell off and pull back, there's room for it to pull back. It's not overbought, oversold right now. So both those are okay. Sentiment, again, is still very, very extreme. I don't expect that to come down anytime soon. Now, what is significant is on the buy-sell ratios. With this recent pullback, you saw the buys come down quite a bit, meaning that the sells were outpacing the buys a little bit. Really what this means, a lot of the buys went to holds, which is good. You'd like to see, in a good, healthy uptrend, you want to see stocks that get stretched, the trend gets a little bit stretched, and then it pulls back in that ABC pattern. And you'd like to see these stocks go from that buy back to hold. You don't want to see that correction, though, be deep enough to where they go to sell. So this is a good sign right here. It means that a lot of these stocks did, because if they went to sell, if a lot of them went to sell, you'd have a big spike up in the sales. The sales have moved up a little bit here, but mostly you've seen the buy signals come down. That tells me a lot of stocks are in these stronger uptrends, and they're just going from buy to hold, and that gives us another opportunity to get in. It means too that you should see a lot of stocks out there that have that corrective type move or look to them. And I've said it over the last couple of weeks. We're kind of having to wait. We didn't want to chase the bullish move that we kind of missed off the bottom, and that's okay. It's hard to tell whether you're in a rally within the downtrend. You don't want to be suckered into a sucker's rally. But then it got stretched. It made the market look more bullish. We broke out of that long-term downtrend line that I was focused on for quite a while. But we didn't want to chase that move. We were waiting for the pullback, and it looks over the last couple of weeks or so, we've pulled back a little bit. I'll show you the chart here in a second. And it should create some new entry opportunities. We could see another move higher. Like I said, I'll show you on the chart here in a second. But whenever you see that, whenever you see the market pull back and you see a big drop in the buys, but not a very big rise in the sells, that's actually a pretty bullish or potentially a very bullish signal. Now, obviously, if you want to look at the chart of the stock and the chart of the market, if that pullback is very impulsive, very sharp moving down instead of choppy, corrective, where it's kind of back and forth as it's moving down, then it could be this is the start of a trend reversal. So I'm not saying that alone, but because I know how the market has pulled back in that kind of choppy fashion, and you see the sharp drop in the buys, it tells me a lot of them have just gone from buy to hold. Potentially, there could be some new entry points in a lot of stocks out there, good entry points in a lot of stocks out there, which is great because you get into these lulls in the market where you can always find a trade, right? But the question is, should you be trading? And most of the time when I have a tough time finding something to trade, that's a clear signal for me to sit on my hands and do nothing. When I know it's a good market to trade is when I'm having trouble knowing which of the many patterns to trade, which one to choose. There's so many of them. And the reason why I love those conditions is that it almost doesn't matter what you choose at that point. You don't have to be perfect at choosing your stock. The market momentum in general will lift almost everything, and you'll at least make money. Maybe you could have made more money with a higher strength rank stock, and we'll get into that when we get into a stronger bull market. We'll focus more on the higher strength rank, 98 strength rank and above type stocks. Right now, we're dipping down a little bit into that 90, into that lower 90 range because there aren't a lot of 98 strength ranks. No, there's more now than there were, but the point is that when all these stocks look good, look like they're starting to have a chance to move up, it takes a lot of the pressure off of you of trying to pick the perfect one. You'll know you'll be able to make money with just the general market momentum. All right, so that the buy-sell ratios are come back. Another thing that did is it alleviated that overbought condition. We're getting a little bit overbought with the wide range there, and now again from this point, we could go either way. Again, we can go up or down. We're not stretched either way from the buy-sell ratio standpoint. Sentiment indicator pulled back a little bit, still a little high. So if we did start to really take off, it wouldn't take long for this to push into that overbought range. So we'll keep an eye on that this week if the market breaks out higher again. See if we start getting close to that range. And I kind of have this feeling that near term the market looks like it could kind of take off, especially after the CPI reports behind us. But I still think we're gonna at the very least get a little bit of a deeper pullback here or correction. Maybe it's just chopping sideways back and forth. I think we have a little bit more consolidating to do, particularly with the ramifications of today's news. Obviously, the CPI report came in a little bit hotter than expected. Kind of surprising, though, the market is up. I mean, that's a bullish sign because that was a pretty bearish report, but the market is reacting more bullish to it. Now, this is a, for those of you that don't know what the CPI report is, or what is a good number and a bad number, don't worry about any of that. I really don't want you to really focus on that because it really doesn't matter. It doesn't matter if you have an opinion on a CPI number, even if you're an expert on the CPI report. It doesn't matter what your opinion on is, whether it's a good report or a bad report. All that matters to us is the market reaction. What does the market think? And so when I point out that these events are coming up, the only reason why I point them out is just so we're aware of them, because the market will trade off of that news. But all we care about is reading the chart. What is the chart reaction or the price action reaction to the report? What are the trading group as a whole? What are the professional traders out there as a whole? Do they think it's good or bad? And the problem with some of these binary events that come up, particularly Fed meetings, you hear me say it all the time, there's often a false move that takes place. Again, kind of sucking people in. And that's kind of what I'm a little bit concerned about. And part of that is that we're still a little bit elevated with the sentiment indicator. Again, with the way we acted today off of this report, could we push higher? Sure, but could that be very short term? Could we rally for a couple of days and then we're pushing into this overbought range, and then we suck some people in thinking, oh, coast is clear now, we're fine, or the market completely ignored that hotter reading and that's very, very bullish, and then it drops right afterwards, or it kind of chops your head off a little bit as it comes back down. So we'll keep an eye on that. Like I said, the other indicators aren't bad. And if we did start to rally from here in a decent way, some of these indicators might push into the early part of that extreme range. But I just think that particular sentiment indicator would get there first, and we'll have to take a look at it. We'll see if it happens to get real close here with one of our updates, and see how the charts look and the price action looks at that time. But just be aware of that. Another thing that concerns me a little bit is on the weekly chart. We don't have weekly charts here on the TradersPro software, but if you're using another charting service, if you look at the weekly chart of the SPY, there's a little bit of a bearish inside week. Last week. Now that doesn't necessarily affect anything in the very near term. Could we still rally in the very near term? Yeah, because that's a longer term chart or candle. But it causes me to not really trust that the rally is going to really take off from here. I'm going to be pretty suspicious of the rally anyway, with just the history of the Fed, the history of the economy and things like that. Seeing some of these cycles, and a lot of times these big sell-offs happen when everyone thinks the coast is cleared, everything's fine, everything's back to normal, and then it kind of crushes you. So I'm always kind of suspicious. It takes me a lot longer to really shift from being bearish to really a strong bull. But then, bull markets last a lot longer than bear markets. And so when I do finally turn really bullish, I can stay in that mode for quite a long time. Then it's the opposite. Then it's hard for me to start to turn bearish again. Takes me a little bit of time to be able to do, at least from a mental standpoint. Obviously, the charts are telling you what you should be doing. You want to be following the charts. And that's where the trust comes in as a trend trader. Do you trust what the chart is telling you? And over the years, that's what I've been able to rely on is I can't rely on my emotions or my my feelings or my intuition at times even. That chart, what the chart is doing when you break a major trend line or you get a bearish reversal candle or something, you learn to kind of trust those things, that something is up, and it usually ends up being right. All right, so another thing too that you can kind of keep an eye on, if you go into the indexes tab right up here, I don't do this very often, and really we're not in any critical phase right now to really point this out in a big way, but I'll take a look at the buy-sell ratios. This is the buy-sell ratio of the entire index. So out of the S&P 5, well, let's just take the Russell 2000 right here. The Russell 2000, we're at a 2.60 buy-sell ratio, meaning there's 2.5 times more buy signals right now on the Russell 3000 than there are sell signals. Okay, now that's actually just kind of a normal, that's a in between reading there that's not showing extreme either way. If you start to see this get into double digits, 12 to 1, 15 to 1 or something like that, that's an overbought state. Now these are not immediate indicators. It doesn't mean you're going to see an immediate pullback in the market or anything like that. But that's when you're in a little bit of a stretch market. You'll likely see it show up on those direction alerts as well. You'll probably start getting into the extreme reversal risk range. But when you get into the extreme reversal risk range on the direction alerts, and you have double-digit buy-sell ratios on the index, a lot of the indexes, look out. That's when you're probably getting ready for a bigger correction. Again, it won't tell you the timing necessarily, but you can start to look for it. And it's a good time to start tightening up stops in your positions, maybe even getting out of taking profits, getting out of some trades, getting back to a little bit more of a cash position. You can use that to as far as making adjustments, portfolio adjustments, as well. The opposite would be an extremely oversold condition, is when you're under one. Anything under one would start to indicate. So right here you can see an example of this. The utilities index is below one. There's not a lot of stocks in this utility index here, but there's eight are at a sell and only one at a buy. That's an oversold condition. That's extremely oversold. Again, it's not immediate, but this could be an area where it could be, in a position where it could start to rally, or you'd look for it to start to rally at some point, because that's an extreme condition. Now, transports are mildly, that's a double digit, so there's just not that many stocks, and that's why I like looking at the Russell or the S&P 500, get a broader range. It's not too hard for these smaller indexes to get overbought, oversold. There's only showing 19 Dow transport stocks, so 10 are in the buy range, only one in the sell. That's getting a little bit stretched, a little bit overbought, and that's something you can kind of keep an eye on there. All right. All right, so let's get to the chart here. All right, so, and this is what I was talking about. You've got this little pullback right here. We were watching that last week. I think on Thursday, it looked like we were in that wave C. We have this move down right here. Wait, is that? Yep, that was Thursday right here. So we had this initial move down, tried to rally a little bit right here, came back down. That's that's kind of a classic kind of ABC pattern. Now it was really quick, and so I'm always a little bit skeptical of the really quick ones. They still work. They can still work, but that with a real quick correction after a longer move like that, sometimes you just get a little bit of a move higher, and then you get a bigger correction, or this could end up being something like this is just the wave A, and then it comes up to here for wave B, and then a few more days it comes back down for wave C, and we just end up being in a sideways range for another week or so. That could end up developing as well, where it's something like that. But when we were in this move right here, what was I saying, okay, we're breaking out of that long-term downtrend line, but we don't want to chase it at that point because it's a little bit stretched. You want to kind of wait for it to pull back. And I also told you how it pulls back is going to tell you a lot. If we started to have a really sharp sell-off right here and came all the way back down, then now we got to worry about this being, that larger. Let me go out to a longer-term chart here. Then we had to worry about that being, a larger bearish ABC pattern right here, and maybe we're starting the death drop or whatever. We're going to get the panic sell-off or something like that. But that's not how we pulled back. How we pulled back was more choppy, more sideways. Now, like I said, could it be that it doesn't even have to be sideways? That could be just wave A, wave B, and you get to move down into here for wave C or something like that. But the fact that this is choppy right through here is correct. That's a corrective move. That's why whenever you hear me use the word corrective, think choppy sideways, because and then it's correct. That choppy sideways move is correcting something, a previous trend or a previous impulsive move. And that's where I get into those stair-step basics, impulsive, corrective, impulsive, corrective. When you're in the downtrend, you get an impulsive down, corrective back up, impulsive down, corrective back up. And so that behavior there is more bullish, because whenever you see a stock moving sideways, chances are it's going to continue to move in the direction it was moving in before it moved sideways. All right, so, and the other indexes are the same. The Dow is really in a larger corrective stage. It's got a little bit of this. In fact, that's a longer term chart here. It's got kind of like a pennant pattern right now. A pennant. I'm a baseball fan, so the only pennants I know of is you go to the ballpark and every team has the flag that's shaped like a pennant, or shaped this way. And here's the flagpole right here, and there's your flag, your pennant. Usually that's in this context, with the previous move being up, this is usually a pretty bearish formation. This is again just moving sideways. It's corrective, but you usually have a distinct line right here, and we're right at it, where if you break out above that, it can start to take off. With all these triangle patterns and most corrective patterns, you can take the beginning of the top and bottom of the correction, or in this case, the base of the triangle right here. You can take this distance right here, and you can project it from the breakout. So if we break out right here, you can take that distance and give you an idea of again, isn't perfect, but something doesn't become a rule of thumb if it rarely happens. It becomes a rule of thumb because it happens a lot, but it's not a law. So it doesn't happen all the time. It doesn't have to happen, but there's a good chance you can get that type of a move off of those formations. Same thing with when you have a stock in a real sideways range. You've seen me talk about that. You can take the distance of the top of the range to the bottom of the range. When it breaks out, it usually goes at least that distance. Same thing with a cup with handle formation. When it breaks out of the cup, you can take the top of the bowl, the bottom of the bowl, and project it upward. And again, I never use these to be exact, to give me exact expectations of what the stock's going to do, but it's nice to be able to visually see where some of these areas where it should get to. It has a high probability of getting to. So it's easier to stay in trades when you know these things, because it's like, okay, there's a good chance you get there. It could get up to that level there. If it breaks out, and that way, if you take that distance, you project it upward, and that way, when it breaks out and maybe it comes back and retests the breakout, you don't get shaken out of the trade, because on these little pullbacks, these pullbacks are what shake everyone out of trades, and what keeps you from getting shaken out of the trade is understanding what you're expecting that stock to do. And these little target areas, they can help you not get washed out of these little pullbacks, and you can stay in the trade long enough to make the bigger profits. If you find yourself just getting whipsawed out of trades, those things are helpful to be able to know those things. But the Dow has a nice little bullish pattern there. We'll see if it breaks out. Comment here. Elliott wave uses 5 waves going up and uses ABC in the corrected move down, but I don't mention the 1 through 5 waves going up. I do when I see it distinctly, but the problem is that corrective moves are usually very distinct. Sometimes impulsive moves aren't as distinct. You could make an argument going back to the SPY, and it still could be the case that this doesn't look very impulsive right through here. You got a lot of choppiness in here. Can I see 5 waves, clear Elliott waves in that move? I can't. I'm talking real clear. And so I use Elliott wave, but I'm not an Elliott wave fanatic. And the markets charts just don't behave as perfectly as we'd like them to behave. And when they are moving when I do see a clear 5 waves, and then I see an ABC pattern, I get excited because that's a really clean chart, and it really makes me feel confident that thing's going higher. But I've had plenty of these where you get a clear 5 waves, a clear ABC, and the stock does this, you get stopped out. So if you're expecting perfection or exactness, you're really going to be frustrated in markets. I talk about this with trend lines as well. If you see a stock come right back to the trend line, I don't have an example here, but and it hits it exactly and it pulls back exactly at the trend line. There's a lot of times where it is exact, but there's a lot of times where it's in a zone. And this is a good case here. It didn't go right back to that line and go up. Well, here it did. It went up that day, but what happened? It came right back down. It dipped a little bit below it. And the reason why it does this, by the way, is because especially nowadays, you've got these algorithmic traders, these computer traders that are programmed. They're programmed to push a stock down below one of these perfect levels because they know people have stops right below there, because they're like, well, if it's going to reverse, it's going to reverse right here. They'll pull it down, stop all those people out, and then come right back up again. And same with resistance areas. It'll break out, it'll come right back down again. And so and yet sometimes it will be exact, because that's what suckers people in to put those stops right below there. So they see an exact spot. Oh, there's a perfect spot. And so, and I know that, it's a fine line between, having a range, or having a rules, and having chaos, having no rules, having discipline and having no discipline. There's a little bit of a fine line sometimes between that. But I have found that the people that are really strict and it's like they're looking for exactness all the time, they often get really frustrated, or they just are an endless search. When it doesn't work, they get on an endless search for the next big thing that's going to tell them exactly what the market's going to do. And and then they get 30 years into their trading career and realize, okay, nothing's going to tell me exactly what the market's going to do, and I probably wasted thousands of dollars chasing it. So Yeah, so I do apply what I really love about Elliott Wave is the psychology part of it. That's what's probably been the most beneficial is understanding, um, bottom behaviors at the bottom. I talk about bottoms. Nobody wants to buy at a bottom. You know, the first move up is just it looks like here we go again. It looks like it's just a rally within the downtrend. The difference though is that when it does start to pull back, it doesn't go back to a new low. It's more choppy, more sideways. Wave two is is that recognition that maybe you're in a trend reversal. Wave three is the most powerful wave. Wave four is kind of the you're it's a kind of a surprising disappointment. It's the first feeling that the trend could be in trouble. It tends to be more sideways, more extended. You get more of those extended, long, choppy moves. Wave five is the final move. You get overconfidence at the top. You feel like the trend's going to go on forever. There's no way you can lose. And, that's a topping type behavior, overconfidence. And then you go into your ABC. But anyway, I love Elliott Wave when you apply it generally and not too specifically, if that makes a lot of sense. Hopefully, I didn't mean to spend 10 minutes answering your question, but hopefully that helps a little bit. I'd like to just try to keep it simple to impulsive, corrective. Now, if I see a long uptrend and, I see an ABC pattern, I usually just assume I'm probably in a wave four. That's a pretty large move already. It doesn't matter though, whether that's a wave five or I'm going into wave three. Does it really matter? I mean, I should get a bullish move. The only difference might be that maybe I have a little bit of a tighter stop on a wave five because I might get the end of the trend, but I can already see that in how far that thing has already gone. And anyway, so that's my 2 cents worth of Elliott Wave. But I do like it. I think it's valuable to learn it. I have trainings on it. If you go to the YouTube channel, you can find some trainings on it. I think there's some even under the education tab too. I think they're posted there as well. All right. NASDAQ, you can see here again, it looks like a correction, and it did kind of pull back to the breakout area there. This is looking like it pulled back exactly. The worry I have is did that correct this entire move up? Could this just be, the first part of the correction and you get either a deeper pullback into here? You talk about those retracement zones. This hasn't even retraced a third of that move. The rule of thumb is stocks will tend to retrace 50% of their moves. That would be more into that area right there. Although that would also mean you would dip down below the breakout area. This kind of fits a little bit more with maybe this is a correction. We do go higher, but then that leads to maybe a larger pullback that comes a little bit later. All right. Now, as far as, we did back out of that extreme reversal risk. The problem is that it wouldn't take much of a pop here to get right back into that extreme range right there. Russell 2000, again, this pullback into the breakout area as well. We'll see if that leads to a move higher. It's so far today, the way I would read the price action today is indecision. Yes, the market didn't drop much on that CPI report, but it's not taken off yet either. And so a little bit of a tug of war going on. Bond market, again, this looked corrective right into here. The problem I'm looking at right now is that you've got this move up and this looks corrective. This looks like maybe an ABC correction. But we're sitting at a 618 Fibonacci retracement level. So, if I were to put the retracement tool on here. And zoom into that area. There's that 618 retracement level. I got a little bit of a funky move on the bar there, but we're right at the bottom. Let me take volume bars off. We're right at the bottom of the. On a second here. Refresh my page here. Just refreshing the page here. Okay, here we go. All right, so we're at a deep retracement. Okay, right at the deepest part of that retracement zone. So if we go any lower, and that could be why we've been hovering there for the last 3 trading days. Not coincidence. I don't think that's a coincidence. These Fibonacci levels are programmed into a lot of these computers as well. But if we dip below there, it doesn't mean that the bond market is going to go down. Okay, but if you break below that last Fibonacci level, it means that the probabilities start to shift dramatically. It becomes a lot less likely this is a pullback within the uptrend, and a lot more likely that you're dealing with a trend reversal. Now, there can be deep retracements. It come all the way down to here. As long as it doesn't go below here, it come down to here and then still start going up. But again, from a probability standpoint, it gets into that argument of possible moves and probable moves, right? It's always a possibility that something can happen. But for example, I'm watching the end of the football game on Sunday. Okay, when the Eagles had the ball with 2 seconds left on the clock, is there a chance that they could have scored a touchdown to win the game? Yeah, there's a chance. But what is the probability of that happening? It pretty much never happens. So the probability is very strongly against it. So the same thing in the markets. If you get too focused on possible outcomes, anything's a possible outcome. But what these Fibonacci levels show you is, where does that probability shift start to take place? Well, right here is where it starts to dramatically shift. You get below here, it starts to shift pretty dramatically that this is actually, you're in a more of a downtrend, or you could be shifting into a downtrend. Obviously, if you break below here, go to a lower low, that would confirm that. And so, we're at a critical spot right here. We either need to start rallying off of this or continue to drop. Now, the market has been moving with the bond market. When bonds have been going up, the market's been rallying. When bonds have been going down, the market has been going down as well. Now, we saw a little bit of that shift. Well, it's not a perfect correlation, but that's kind of what's been happening lately. In fact, a lot of times you'll see the opposite in bull markets, where you'll see a lot on the big down days. You'll see bonds go up, and vice versa. So we're kind of at that critical spot right here. We'll see if this holds. We'll probably hopefully we'll have a better idea on Thursday. Otherwise, we might just be moving sideways all week or something right there. And that would actually, the more sideways we move, the more bearish that would be, because we were moving down before. Anytime you see a stock moving sideways, you want to pay attention to the direction it's moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. So I would expect that if we haven't moved up much from here by Thursday, that we're probably more likely to continue lower, if we don't already start moving lower by then. Gold's had a pretty big pullback, but this is exactly what I was talking about. What I talked about last week, I said, well, we had this little sideways consolidation, this sharp move down. Whenever you see it moving sideways, what was the previous move? It was down. We're more likely to continue to move down. We have. Now, we have gone lower. It doesn't say you have to go a ton lower. It just says that, you know, that it should continue lower out of that sideways move. A little bit of an indecision day to day. What I'm looking for is, do we get a bullish bar here? Where we've had a pullback, a good pullback in gold. I still am longer term bullish in gold. You know, if you want to keep the context here, we go back a lot further. We probably need to go back a lot further. This was, this huge run up, and this was like wave A, wave B, wave C. And if that's the case, we're just getting started on a pretty big run. And we had a pretty big run off the bottom right here. This is the first decent correction out of that. And so those trades I have in gold are more longer term, and so I don't want to be shaken out of them. That's why I have some pretty wide stops, but I do have stops on them, and they're getting close to them. I'm not afraid to stop out if it pulls back deeper, much deeper than this. I can always get back in when it starts to look more bullish again. And so, but I did purposely have a little bit of wider stop on those because I'm trying to stay in the trend for a much bigger move. And I was willing to risk the amount from where I entered to my stop. When I first got in the trade, I analyzed that. You see me do that all the time when I get in. I'll analyze the risk, and I'm willing to take that risk. And we'll see if this holds here and starts to move back up. It'll just so far it looks like we're just a corrective move. If that changes any dramatically in any way, I'll point that out. Oil's been stuck in kind of the sideways move, but we've identified the range, that near-term range. If it gets above here, that'd be more bullish. It got all the way up there and then pull back down to these lows. Now, what's significant about these lows down here is this is where the government used all that strategic petroleum reserve. They put oil out on the market to keep prices low. I never liked that because even though it makes it easier for me to pay cheaper in gas, I just don't like politicians messing around with that, because it's called a strategic oil reserve for a reason. It keeps us from having to rely on Russia or some of these countries that aren't friendly to us. If there is an oil crisis and something happens in the world that makes oil very rare, we need to have that supply to defend ourselves. Think of all the weaponry we'd have to that uses oil that we'd have to have if we got attacked or something like that. I'm not suggesting it means that this is a massive problem, but hopefully we start building that up again and looking for new reserves and things like that, or stop just using it because that we need to keep it for when we really need it. But the government is supposed to be buying back oil to replenish some of those reserves, and the floor price is down in here. Now, it doesn't mean that oil couldn't go lower than that, but understanding that there's a big, huge buyer, one of the biggest buyers in the world, or the biggest buyer in the world, sitting right here to buy at these levels, it's going to put in a little bit of a floor. Now, the only thing I worry about, though, knowing that and understanding that, is everyone has heard that. In fact, I think it was announced on or talked about on CNBC within the last couple of days or so. Somebody mentioned it. And so the problem I have with that, when everybody is aware of that, it seems like, hey, you start to think, oh, there's no way oil is going to go below that, and you get overconfident. Remember, those computer algorithmic traders, they're programmed and designed to deceive you and to whipsaw you to death. Wouldn't be shocking if oil came down to these levels. Everyone thinks it's a guaranteed buy right here, and those big, powerful traders push it down lower, stop everybody out, and then bring it right back up again, or have it come right back up again. Do something to manipulate the price right there. Again, when something is obvious in the market, be skeptical. Don't be confident, be skeptical, especially if everyone knows about it. And trust me, just because you're the only person in the room watching CNBC does not mean you're an insider. Anything that's talked about on on that station is going to be something everybody knows about, and everybody thinks they're an insider, but they're not. All right. All right, let's but we're kind of in the middle part of that range, and so and we did slip a little bit at the open here, but we're coming back up. But those are the areas that we want to keep an eye on. Overall, though, I am more bullish on oil. If you back out, and look at a longer term chart. Let's go to a 2-year chart. You can see, obviously we had the big run up through here, and we pulled back quite a bit. But notice what's kind of happening right now. You have a lower low right here, lower highs, a little bit of a higher high right here, but then followed by another lower high. But now you've started to get higher lows. That was kind of a even low right here. That's kind of another reason why I'm looking at this area right here. If we break out above there, that'll be now you've got higher lows and higher highs. It looks like you're maybe moving up the right side of the bowl at that point. Now, obviously, if we dip down below there, that'd be more bearish for oil. But it's hard to believe that it's going to dip significantly below there with, again, knowing the government stepping in to buy it in that area. But I wouldn't be surprised to get some sort of a trade that would stop people out. All right. The dollar, now the dollar is looking more bullish to me. And again, you can see why. You can see recently it's just been moving sideways. Right? You had this sharp impulsive move off the bottom, but now it's been moving more sideways. Now, whether this is just A, B, are we going to move up for C, and then it continues the downtrend, or whether this is a start of a new uptrend, that's wave 1, wave 2, and we're about to get wave 3, 4, 5, elevate patterns there. I don't know yet, but in the near term, this is very bullish looking. Now, sometimes this could be A, B, and C could drop you down a little bit in here before it goes higher. That would actually fit the argument that, especially since the market has been moving with the dollar pretty well recently. We talked about that. It would make a lot of sense if this is A, B. We've already talked about not thinking the market should go higher off of this correction, but maybe not too much higher. Well, maybe it's going to go higher as the dollar drops down into here, breaks out to a recent high, breaks above this corrective level, the S&P does, and then the dollar has a move up, whether that's a wave C or whatever. The market drops, maybe a bigger drop. Who knows? But that's something to keep an eye on. We know that correlation. It's not always correlated that way, but as long as it is, we're going to watch for that. But looking near term, the dollar could pull back a little bit, I think. But overall, I think it's got another move higher soon, yeah, based off of that pattern. Now, like all patterns, it doesn't always guarantee that it does that. But again, the probabilities right now are pointing to a little bit of a rally higher in the dollar. Like I said, near term could drop down a little bit lower. A few days could come down a little bit lower. It doesn't have to, but there's room for it to do that. But overall, I think we're going to see the dollar move up at least temporarily, which would tend to be more bearish for the market right now. So we'll see how that plays out. Keep an eye on that this week. The VIX, my biggest problem, as you know, with trusting the rally is the VIX down below 20. It came right down below 20 again. It wasn't what was actually pretty bullish on Friday was that we had, let me go back to the SPY chart here. We had, remember Thursday we had that move down that looked like wave C. The VIX was going higher. Remember, we were talking about that. Then Friday, we had a bullish reversal candle right there, right at what could be the bottom of a wave C. And we had a bearish candle, reversal candle, right here on the VIX. Now, it did open a little bit higher on Monday. I think part of that was an anticipation of the CPI coming out. It made people hedging a little bit, but then now it's come way down. And again, here's the problem though: is we're still a bear market. We're still in an iffy. Could this be a bear market rally or a new bull market? We're still in that kind of question mark. This is too low of VIX for those conditions, in my opinion. This is the bottom in a bull market. This is usually the bottom of the range. Usually the VIX will come down into here and up into here during bull markets. And we're not in a bull market. It's just, I don't know. It's hard for me to believe the market can rally significantly with the VIX this low. Again, is it possible that it's different this time? Yes. Is it probable? Probably not. And that's why I'm remaining cautious. Okay. All right. So now the chip stocks, they've been outperforming. We talked about this, really performing strongly. They look like they're coming out of a correction here as well. Recently broke out of that range there. Definitely what you want to see in a bullish trend is the chip stocks leading. Now, what you could look for is, are they the first ones to roll over and drop? If this is if there's a deeper correction coming. So far, this looks like it should move higher. So if you're looking at a very short-term trade, I'm talking probably a day or two. We'll go much further than that. But if you've got a pattern on a chip stock that you like, you might get a little bit of momentum there for a couple of days where it could go higher. Definitely a strong day today. You compare that to the S&P chart. Remember, the candle was more indecisive. This is a reason to be very bullish in the near term. Transports, again, looks like they're coming out of a pullback right here. Looks like it tested the breakout. Now, these aren't real strong moves off the bottom. Anytime you open mid candle and you're barely going higher, it's a little bit of a sluggish type move here. It closed up here and then opened lower, managed to go higher again at the end of the day. But these are kind of sluggish moves. You're moving higher, but it's not taking off. You'd like to see something like this where it come off a bottom and it shows. Well, just go back to the SMH. Had a little bit of the same thing today. A lot of that was due to the report coming out and a little bit of weakness early, but that's a strong candle, clearly stronger than the day before. And even on the day before right here, here's where we closed on Friday. We opened at the high of Friday or the open of Friday, and then we closed much higher than that. So that's a bit stronger momentum right there. This gets back to looking at the trading range. When you're inside, when you're trading inside the day before, you don't want to make any strong judgments. When you break out of these, it's like, and we're likely to break out of that range from yesterday here on the transports. But tomorrow will be interesting to watch that range. Do we continue to break out higher that range, or does it come back into that range? Bitcoin had a pretty big pullback. Nice day today, though. Now we're sitting at about a 50% retracement of that move up. You don't want to see it get too much deeper than that. So if you're bullish on Bitcoin, you'd want to see it start rallying up a little bit from here. If it does dip too much below this area, those probabilities start to shift. It becomes more likely you're going to retest the lows or go lower. It's a pretty good jump right here that we had where we broke the downtrend line, broke to a higher high right through here. I'd like to think that this is the bottoming process, and we're going to start to see more of a bullish movement on Bitcoin. Now this could just be, this looks a little bit impulsive on the way down right here. So could it be that this is kind of wave A, wave B, and you get wave C or something like that? A little bit more choppy. That could happen. We'll keep an eye on that. But a pretty good bullish bar today if that holds up. And we'll see if that leads to a little bit of a bounce here in Bitcoin. All right. Yeah. See, so you look at the S&P chart compared to the chip stocks. Chip stocks are showing a really strong day today. That's still looking a little bit iffy, a little indecisive. All right. I want to save most of the stocks for Thursday, but I know people tune in and want something, so we're just going to go to the new buy list. Pull a couple off of here. The top one up here, this TMDX, looks pretty good because I like the consolidation pattern. It's in a corrective pattern right here. Let me switch this over to signals. He kind of broke out and kind of retested the breakout. I also like the larger trend here. You haven't broken that trend line. You might want to make sure you don't break that trend line. That gives you a good, well, you got a combination of the two. You have the breakout here, it's a little bit below it. See, this is what happens. Look at that big down day, stopped a bunch of people out right there, and then it comes right back up. But you could get a stop down below here. It would be below that breakout. It'd also be below the trend line. Define your risk. I would know I was wrong at that point. In fact, you could probably have it up a little bit higher than that. It's probably have it up around here. A little bit of a bearish candle today, so it could be that it comes back down and retests the breakout there. But it could also be, it's also really close to try to do it a couple times, close to breaking out higher here. You could wait for the breakout, see if it breaks out there and go with it. Depends on how much confirmation you're looking for or how much risk you're willing to take. This is a lower risk entry point, but it could also stay sideways for 3 months. Breaking out of the range, it's more likely to take off at that point, but your risk goes up. Now, if you are buying the breakout, then I would probably just use a stop down right below the range, right below there, which is probably about the same spot, maybe up a little bit, not much, but I like that pattern. Another one on the list, this Grand Canyon Educational LOPE 94 strength rank. Now, this is one you want to watch that trend line right there. It's right at it. If it dips below it, that would not be good. But overall, the trend is still up. A little bit of a trend range through here you can kind of follow. Let's see. This LW 94 strength rank, kind of a flag or pennant pattern right here. Now this is one you could wait for the breakout. It's right up there, up to the top there. See if it can break out, because it could come back down and stay in the sideways range. Part of the problem, I like sideways corrections. I just don't like them to last very long. This is getting to the point where if it doesn't break out right here, if it starts to move back down lower part of the range, I don't want anything to do with this thing, because you want some indecision. Some indecision is just the market trying to digest the move, especially if you have a really big move, and that was a pretty big move right there. But at some point, it's like, okay, make up your damn mind, right? Obviously that's not good if you're staying indecisive that long. It means the bulls just can't find a reason to want to buy it higher, and the bears can't find a reason to short it lower. And man, sometimes these could be held. You could be stuck in these for months. And so now, where is that point? To me, it's kind of visual. You know, right here would have been fine. And if it dipped down right here as it started to come back up, I still would have been okay. And even right here, just because we're right at the breakout spot, if it breaks out right here, great. But if it doesn't, it comes back down again, I'd be done. I wouldn't bother with that. It's just too much indecision. And maybe you come back later and it's broken out and taken off, and it gives you another chance to get. Maybe it breaks out and comes back and retests the breakout, and then you can jump in at that point. But this is right at that borderline of being sideways for a little bit too long. Yeah, it's either a triangle, a pennant, or wedge pattern. All those are potential patterns for this. If it is like a bearish wedge, then you really look at the support line right there. If it breaks that support, you're pretty likely to get a bigger move down. All right. And lastly, there's one I pointed out. I think I pointed out some recent classes. That's FLEX. Now this one's it's getting to that point where it's getting to be a little bit. It's on the borderline of moving sideways too long. I liked it right in through here. We had this look like an ABC. Remember a couple weeks ago or something, we were in a stock specific class where I pointed this out. You had this larger correction, and you had impulsive, and you had side corrective right here. Then you had this big down move, and then followed by a big up move. And then now it's back up here ready to break out. So this picked up the volatility of the move. You got big down, big up. Buyers bought it down here. They're buying it down here. It's just got to break out, and I would wait for it to break out. If it comes back down again, I'd be done with it. I wouldn't want to wait on that one. All right, real quickly here, I had a question on a stock, CARR. That's nice looking uptrend there, and you're in the oil stocks. That's right. There's an oil refining. You're in an oil stock, which is looking still very bullish. Now you get a little bit nervous whenever you see. I get a little bit nervous anyway whenever you see. What you want to see when you're breaking out is you want to see when you come off of a correction, you want to see impulsive off of that. Anytime you're rallying, it's a good example. So here was a little corrective move, but as you were rallying, this looked like it was choppy as it's rallying. There's an Elliott wave pattern called a diagonal fifth wave that can show up in the final part of the move. And what the characteristic of it is, you get wave 1, wave 2, wave 3, wave 4. Usually wave 4 is a real sideways move, and then diagonal fifth wave is a move higher, but it's very choppy and corrective looking. A lot of times that shows up in the final part of a move, and it can be. And now diagonal fifth waves are very rare, so I usually don't immediately assume that it's a diagonal fifth wave. In fact, a lot of times I wonder if it's still just part of the wave 4, larger wave 4 mess. But that's a good example right here where it's breaking out, but still real choppy. You got the sharp move down right there. That might be, unless this thing starts to take off, which it could, because oil's looking more bullish. Remember, oil wasn't looking as bullish back here as it does right here. So this could be different, but you'd want to see a little bit more of an impulsive move out of that. Now, if you're already in it, there's no reason to get out of it. Just be aware that if it starts to drop sharply, or that it could be in for a little bit of a bigger correction. I can do one more. I'll do this one more, and then I got to wrap up. If you have stocks you want me to look at, try to get them to me earlier in the presentation. So I can just plan time-wise because I want to make sure we keep these right around an hour because people start to get impatient around an hour. But if I know how many to go over, I can kind of gauge my presentation a little bit out of that. All right, so this one is ARDX. Oops. Yeah, kind of the same thing as we were talking about. You got a little bit of this, looks like a corrective move within this uptrend. Down day to day, looking like it's headed towards the bottom part of that range. So if you're looking at an entry here, I don't see a good entry here. You either want to get in on a bullish move off that lower part of the range, or wait for the breakout. And again, this one's it could still come down and come back up, but on that move up, it would need to break out for me. Like I said, you had a little bit of indecision. This one was probably stretching the sideways move for me, but it did end up breaking out right there. And if you're worried about it, just wait for the break. Put it on watch list and wait for the breakout. You can do that. That's always the safest entry off of some of these sideways patterns, just to wait. Although sometimes the breakout move can be very strong and can be a big chunk of the rally. So like here it broke out of the sideways range. It broke out, and then if you were waiting for the breakout, it immediately went sideways. You probably didn't make much and got really frustrated when it moved sideways right there. That's not a bad pattern. All right. That's all I have. Do you have any other questions? Make sure you send those to Jerry at TradersPro.com. I'll be happy to answer those for you. Have a great week. We'll see you on Thursday for the stock specific class. Bye, everyone.